The graded quizzes are making their way around, so please grab yours out of the stack. I think that this quiz definitely had the highest average of the semester. So good job on that one. I'd encourage you to take a look at the grade book, and if there happen to be any discrepancies between what I've typed in and the score on your paper. Is there a question? So if there's any discrepancies, let me know. It becomes exponentially more difficult to change grades the later we get in the semester, and especially after grades are submitted to the registrar's office. So please take a moment just to look over the grade book and make sure that everything's been entered correctly, and please tell me if there's a mistake. Our final exam is Friday the 10th. So that's next Friday, and we're doing it from 10:15 to 12:15. I was really glad when we avoided the 8 a.m. exam spot. Those aren't good. So just like the previous tests, there's going to be two parts for this one. Concept questions where it's closed note, closed book. The only resource you've got is your mind and a pencil. And then on the problem solving, you're allowed to use an equation packet that I'm going to provide, the factor formulas, as well as one page of the equations or notes or outlines that you want to include. So you can put anything you'd like, but you can only use that document that you prepare on part 2. It can be typed if you prefer. It can be handwritten, whatever you like. We're going to discuss a couple of concepts in class today just as maybe an initiation of your review. And it's by no means comprehensive. It's just an illustration of some of the ideas from earlier in the course that are still important. And if you realize, wow, I haven't thought about that in a long time and I'd have no idea how to answer it, then this may be a trigger that you need to spend some time preparing for the test. So we'll go through that in just a minute. This last section of the course, though, today's lecture and then again on Friday, we're going to be talking about taxes. And of course, taxes are a really important part of whether companies are profitable. And you saw the effective taxes, hopefully, in your project, where your earnings would have been so much greater if it weren't for the fact that every year you're losing 20, 30, in some cases 40% of your income to taxes. So we'll talk about all those effects today. By the way, this is the equations that I'll provide in addition to factor tables. So anything else, any other equation, so for example, the learning curve equation, I'm not going to provide that. You'd need to include any equation that you've used this semester that's not this or the factor tables should be on that equation sheet that you prepare as you study for the test. Any questions before we move? Yes? Yeah, I would give you those MACRS factors. I don't expect you to waste your valuable real estate on that. I'll give you that. I'd just put that onto the problem page itself. It wouldn't be a separate handout. Other questions? All right. So let's just go through this quick spot check of your concept comprehension. The repeatability assumption. So who can briefly explain the repeatability assumption? And so when I say explain it, what I'm saying is, tell me when is it used, why is it used, maybe what are some built-in assumptions when it's applied. Basically, give me an overview as you were teaching the concept to someone else who'd never heard about the repeatability assumption. Okay, so that's definitely a part of the repeatability assumption. The repeatability assumption that not just the cost, but also the revenues are going to be the same. And so why would we make that assumption that if you have an item and you're buying it now, that it could be bought for the same amount in the future, and that the revenues from putting it into service are going to be the same? That's what the assumption is. When is the assumption utilized? Yeah. Exactly right. Yeah, so if you've got option A, which lasts for 2 years, and option B that lasts for 3, Remember, the only way we can compare them is either by making them repeat over the same study period, or if we use the annual worth assumption, then we could compare them. All right, so be really careful on these explanation problems that you don't just explain one aspect of the repeatability assumption, like what is the assumption. You also need to describe when is it applied, and then maybe what are some warnings, or like maybe what's unrealistic about this assumption. And so the unrealistic thing is we know that for the most part, prices are always increasing over time. And so to assume that you can buy the same thing in cycles for the same price over and over again, that may not be a very strong assumption. Okay, now what if you can't use the repeatability assumption? There were a couple of other tools we talked about for comparing items with a different useful life. So what are the other techniques? Contract services. And what is contract services? If we've got a long cash flow diagram and a short cash flow diagram, how does contract services make it so that they're the same length? You rent what in the end? You rent an identical substitute to the thing that you initially had used and worn out. You just rent something that's going to allow you to generate the same revenue. Right, so contract services is just talking about like a non-permanent option, whether it's leasing equipment or maybe even subcontracting to someone else for the remainder of the study period. So what contract services does is it lengthens the shorter alternative so that they both terminate in the same number of years. Okay, so that's one of the two. Early termination. Exactly right. And I don't even feel like I have to recap that because he said it perfectly. All right? So contract services, early termination. All right. Any questions or comments about this second one? What's the main advantage of the ERR method compared to IRR method? Now, sometimes when I give a problem like that, the student will answer, ERR stands for external rate of return, IRR stands for internal rate of return. And that's the full extent of the answer that I get. Well, I'm always pleased when you know what the acronym stands for, but that's really not the heart of this question. And also, it wouldn't be the heart of the question. You wouldn't be answering it entirely if you just define what each of them are. This is saying, what's the advantage of one compared to the other? So what's the advantage of external rate of return method compared to internal rate of return method? So think about, why is one better than the other? Okay, now that's the difference, but why is it an advantage? Why does that make external rate of return better than internal rate of return? Pardon me? The net profit. Well, I mean, you could argue that both of them are calculating profit expressed as a rate. You have to put the money back into it. Not that you can, but that you have to. So you're definitely onto something there. So ERR is more useful. It's more realistic. Of the investment options in the world, a relatively small fraction of them are going to allow you to reinvest all of the profits back into the same thing. And that's what has to happen in order to calculate internal rate of return. So this tiny little sliver of the overall pie can be analyzed correctly with internal rate of return. So the advantage of external rate of return is that it's more realistic, that it doesn't have at its core an assumption that's almost never true. It's more complicated, it's harder to do, it takes more time. Those aren't advantages. The advantage is with its broad applicability, and that it's more realistic. Does that make sense to everybody? All right, so when you get a question like this, think it's not defining acronyms, it's not explain what each of them are, but look for the keyword here, and like the heart of it is compare the two and tell me why one of them's better than the other. So you kind of have to be reading pretty clearly sometimes for some of these concept questions. Problem 4. Why is money now more valuable? Okay, inflation. Those are both, I love both of those phrases, but explain, elaborate. Very good, okay. Now tell me why. Tell me why money, I mean, if I was grading that, I might say, well, you've just restated the question. You know, like, it's true, money in the future has less purchasing power, but that's the same thing as saying that it's more valuable now than in the future. So, like, why is it that money in the future has less purchasing power? Like, sometimes I'd underline why in your response, just to emphasize, yeah, that's true what you said, but why? Why?
Because of inflation, because the pool of total dollars expands every year.
Okay, finally we've got it. And if you were just going to leave it at inflation, I was going to say why again. But you nailed it on that last part. So there's more money in the world, so the pool of dollars that's out there is greater. And so there's more dollars buying not the same amount of stuff. There's more stuff out there too, but generally the rate that the money supply is growing is faster than the rate that goods are growing. And so there's more dollars chasing, relatively speaking, fewer things. So, I mean, all of those answers that people have said, nobody said anything wrong. You got to really go all the way around the concept, you know, like look at it and describe it from every angle. So money now is more valuable than money in the future because currency in the future is going to be competing with a greater pool of other dollars for the same things. Lots of ways to describe it. All right, so finally, benefit cost method, a shortcoming. Remember that we have to use different methods for analyzing public service projects. We sometimes call them cost alternatives compared to options that generate revenue. Public service projects more often aren't generating a positive rate of return. So we have to use things like benefit cost or cost effectiveness analysis, and none of them are great, none of them are perfect. So tell me, what's one problem with benefit cost method?
One problem with benefit cost method is that it doesn't tell you, like if your B to C ratio is higher, it doesn't tell you which one's going to accumulate more money. It just tells you that you're going to have some revenue.
Okay. So you're saying if you were using benefit cost method to analyze different alternatives. It sounds like what you're describing is more than one option being analyzed. Am I right? Is that what you're talking about? Okay, so he's right that by just looking at the ratio alone, it doesn't tell you which option is best. And by the way, what would we have to do if we wanted to find out among alternatives which option is best? Incremental analysis. Exactly right. Okay. So that is one shortcoming. What's another shortcoming with B to C method?
It's hard to accurately monetize a benefit as compared to a real cost.
Exactly right. So elaborate. Like, give an example of a benefit that would be hard to turn into.
Build a road.
Okay.
The road makes my commute 15 minutes shorter. Well,
right.
How much money would that actually worth?
Very good.
Put that into, it's exactly worth $101 per year for me.
Exactly. Yep. So remember, this is a ratio, and everything that goes into the ratio has to be in the same units. Otherwise, we can't combine them. And the units for everything in this ratio is dollars. So we're talking about everything from environmental pollution to reductions in delay to added noise. And I mean, all these factors have to be translated from their subjective kind of like human impact potential. They have to be translated into dollars. And that's an imprecise activity, to say the least. All right. So those are just a couple of ideas, and like I said, this is not exhaustive. You know, we've had 43 lectures now, and so you could go back through 43 sets of class notes, 43 recorded lectures, the in-class exercises, and there's just big ideas in each one of them that probably I could find some way to ask a question on the concept part of the test. Any questions about these before we start talking about taxes? All right. Here is a receipt from Walmart. I'm sure everybody here has been to Walmart. Is there anybody here who's never shopped at Walmart? No? We've got a couple of international students. Both of you, you've both shopped at Walmart? Yeah. I used to teach overseas. I told you that, right? And when I was teaching overseas, I brought a couple students to America for the summer to take a class here and just to like live in the U.S. And most of them were from Iran. So they'd never been to the U.S. And we went to Taco Bell the first night they were here. They picked up the taco and they eat it like a sandwich. Like everything was falling out of the sides, you know. They didn't know. I had to show them, no, you turn your head and you hold the taco upright. Otherwise, everything's just falling out. That's like my favorite story of culture shock is these Iranian students trying to eat a taco. But I guess everybody's been to Walmart. Everybody has seen that one component of your Walmart receipt is taxes. Now, I'm not exactly sure where this is. Huh? Oh, Virginia Beach. Okay, so apparently in Virginia Beach, these are all, it look like junk food. So typical Walmart purchase here, Pepsi, Pop-Tarts. So junk food in Virginia Beach is taxed at 2.5%. I think that probably the tax rate for other stuff is higher than that. I need to find a better receipt just to illustrate the fact that in a lot of states there's one rate of taxes for general goods and then a lower rate, sometimes even zero. Like here in West Virginia, our food tax is 0%. In some countries outside the United States, rather than sales tax, they'll have, like in Canada, it's called GST. I think it's General Services Tax. And so more commonly, like the item, and when you look on the shelf, it has the sales tax built in to the price that's displayed. And so you don't, in your mind, have to be constantly figuring up, well, what is it actually going to cost? But then on the receipt itself, they tell you, like this is from Switzerland, so 54.50 Swiss francs, of which 3.85 was taxes. So it's just a little bit different that the taxes are included at the front end versus the back end. And here's a comparison of tax rates. I guess we were just looking at one in Virginia Beach. The overall sales tax rate in Virginia is 5.63%, which is lower than West Virginia. And this is even ranked from highest to lowest. And let's see, where's number one? Louisiana, 10.02%. And then there are a handful of states that don't have any sales tax. Oregon, Montana, New Hampshire. Looks like, what's that, Delaware? Yeah, Delaware. Okay, so taxes vary widely. And sometimes it's just that they have a different mindset for how taxes should be collected. So for instance, in Texas, you notice that the sales taxes are relatively high. But if I'm not mistaken, we're going to look at a slide in a minute that has property taxes, and they don't charge property taxes in Texas. So it can vary quite a lot. And sometimes the problems arise when you live in a border state where there's high taxes in one and low taxes in another. So think about a state on the Washington-Oregon line or Oregon-California line. People are going to go shopping in Oregon anytime they want to buy a TV or a major purchase. Generally, they avoid you doing that sort of thing with cars. They figured that one out. But with groceries and so on, they usually just lose the revenue. Although there's a border town in Switzerland, the Swiss city of Geneva is very close to France. The French city is called Annemasse, right across the border. And the groceries and everything are so much cheaper in France that Swiss people will go across the border for their grocery shopping, but then coming back in, if they buy too many sausages or too much food and don't declare it, then they get in a heap of trouble. So it's kind of an interesting thing to see someone getting busted for bringing too many sausages into the country undeclared. All right, a value-added tax is a more sophisticated way of collecting revenue than sales tax. A sales tax, it's only the last transaction that is actually getting taxed. So it's the exchange between the retailer and the retail purchaser. So like when you go to Walmart, Walmart is collecting the sales tax on behalf of the government and then submits it to the government, probably on a regular basis, more frequently than quarterly, I'd guess. But value-added taxes are collected every step of the way. And so just as an illustration on why that would be better, the reason why is it kind of reduces the incentive for black market activity. You know, there are some places where, for example, taxes on cigarettes are so high that people will buy cigarettes in one state that has a low cigarette tax and then like get a truck full of them and drive them to New York City, something like that. Maybe a summer job opportunity for you there. But value-added tax would help to prevent that, because what happens is in every step there's just a little bit of tax that's being collected, and the tax isn't based on the total sales price of the item, but the tax is based on the difference between what you bought the item for and what you're selling it for. So the value added, the tax is only being applied to how much you improved the state of the item. So take this illustration of if we're going to be selling shirts. So when the farmer grows cotton and sells the cotton for $1, then actually the amount that they'd have to collect from the textile maker is $1.10. So it's $1 that they get to keep, the farmer's keeping, and then they're collecting the 10 cents, which is 10% of the purchase price. So you see here on this row, the seller, who is the farmer at this stage, collected the 10 cents, and they grew the cotton from seeds, and so they don't get any credit for previous stages in this chain. So far, it's 10 cents that's been collected. But then when the textile maker takes the fabric and turns it into takes the cotton and turns it into fabric, maybe they're going to sell that fabric for $5, and so their net sales price, what they charge the clothes maker, is $5.50. But here's where things get interesting. Remember, in the last step they paid 10 cents, and they're collecting 50 from the clothes maker, and so they get to reimburse themselves for the 10 cents that they paid in the previous step. And so really, the amount of value that they've added is the difference between the $1 and the $5. So they've added $4 of value, and so they only have to turn over to the government authorities 40 cents. So they're paying, the net difference that they're paying is 10% of the value that they've added during their stage. So the next stage, this $5 piece of fabric gets turned into a $12 shirt. So the difference between the two is $7. And so you'll notice that the net tax that's collected and turned over the government is going to be just 10% of the value added. And they're reimbursing themselves the 50 cents that they've paid previously with a part of the $1.20 that they collect from the retailer. It seems complicated the first time you see it, but in reality it operates really smoothly, and countries that don't have sales taxes, when they just start, like the United Arab Emirates, I was there over spring break, and since I was there last, they've introduced this value-added tax, and it was totally seamless. It's a country where there's never been any property taxes, no income taxes, and no sales taxes. And so people are not accustomed to paying taxes, but just in the short space of a couple of years since I was there previously, they've adopted the value-added tax, and every shop that I went to was collecting it. Even these little transactions where it's just you're paying cash, and it would be so easy for them to avoid taxes if it had been a sales tax by maybe selling things under the table, so to speak. The value-added tax eliminates a lot of the incentive for tax avoidance. And so it's just something that you can be aware of, and this diagram, I think, explains pretty well who pays in each step. Any questions about a value-added tax? A gasoline tax is a category of an excise tax. An excise tax is something that's applied just to a specific item rather than to an entire category. So a sales tax is kind of a general tax, but an excise tax is usually one item at a time, and they're either applied because you want to collect a separate pool of revenue, and that's what is the case in gas taxes. The money that's collected for gasoline tax isn't supposed to go towards schools. It's not supposed to go towards national defense. It's supposed to go to maintain the roadway network, and a small fraction of it to go into research related to transportation. And again, you'll notice that it varies quite a lot from state to state. And I notice it every time I'm down in South Carolina, like I was last week, working on the FE exam. As soon as you cross the border from North Carolina to South Carolina, gas is about 20 cents a gallon cheaper. So where did I fill up? I filled up in North Carolina because that's where the airport was. But if I had been, living in the border region between the two, I'd probably fill up in South Carolina. So it's interesting to see the variation from state to state on the gas taxes, but what really is amazing is the variation in cigarette taxes from place to place. And generally the way it works is that states that grow tobacco, like Missouri, Kentucky, Tennessee, Virginia, they historically have been tobacco growing regions, have relatively low cigarette taxes, whereas states that have more cities and less agriculture would generally have higher cigarette taxes. So New York State, $4.35 a pack, and then there's, if you're in the city, a separate tax that goes on top of that, so that a pack of cigarettes in New York City it's well over $10 for a package of cigarettes. No, that's per pack. 20 packs of cigarette. Yeah. Just perspective, I told you that taxes are low in the United Arab Emirates. You can get a pack of cigarettes there for $1. So I don't think that they're applying. This is another excise tax. It means it's specific to an item. And so the rationale with the excise tax on the gas, remember, was to provide funds to apply to the transportation network. What do you suppose the rationale is for a tax specific to cigarettes? And
recoup some of the costs that the government incurs to do like Medicaid and Medicare to pay for people that smoke cigarettes.
That's right, yeah. People who are smoking cigarettes externalize that cost. They're not the only ones who are paying, although they pay a hefty price with the health consequences. But then generally, insurance companies and state agencies are going to have to pick up some of the tab of their cancer surgeries and everything else. And so this is to recoup some of that, and then also just to discourage smoking by making the prices higher, because there's a relationship between, remember, price and demand. Here is, if you, on a per capita basis, add up all of the excise taxes. So this is saying tobacco, alcohol, and motor fuels. So it varies a lot from place to place, just depending on their respective tax philosophies. So let's go over some terminology here. The excise tax is specific to certain goods, and it's usually applied to things that are considered non-necessities. And it's independent of the profit or the output of a company. Now, in comparison to that, we've already talked about what sales taxes are. They're usually going to increase the cost of items that, in a construction standpoint, the cost of items that are being purchased for constructing new projects, for equipment that's being put into the field, that's generally always going to be applicable. There's, in some states, if you're working for a government agency, then you don't pay sales tax. I remember when I was going to school at Purdue, since Purdue is a state school, we had a special credit card when we go to the hardware store to buy like research equipment. We'd pay with this special credit card, and there was, in the same envelope that we'd take to the hardware store with this credit card, there was like a tax-exempt certificate. And so when they'd ring up our purchases at the register, since it was a state agency, we didn't pay sales tax. Here in West Virginia, that's not the case, though. You still do pay sales taxes even when you're a state agency. At least I always have when I've been out doing purchases on behalf of the university. Property taxes are based on land, buildings, equipment, like vehicles, for instance. And you have to pay on an annual basis on the value of the item. So it's not like an income tax where you only pay a single time, but you pay every year the basis of the property. And here in Cabell County, the property taxes go to support largely the schools. We're going to look up a figure that's on the Cabell County website that says where all of those funds go, just to give a sense for all the different things that get supported with property taxes. And the property taxes, by the way, here in Cabell County vary. If you live in the city of Huntington, you pay a much higher property tax than if you live in just the county itself, in an unincorporated area. And the reason there is that the city of Huntington provides some services that aren't included in remote county areas, like a paid fire department, most notably. A separate police force that's in addition to the county sheriff and so on. Income taxes we're going to go over in detail on Friday. We'll actually go through the process of filling out a 1040 form. I know some of you have been paying your own income taxes for a long time. Maybe you've just used like Jackson Hewitt, or who's the other guys that do it? H&R Block, but TurboTax, yeah. It's not brain surgery. We'll actually just go through the form itself and fill it in manually and get a feel for what that's like. All right, so here in Cabell County, there's some terms that I need to tell you about. Your assessed value, the assessor is the person who goes and identifies what's the value of the things that you own. So you have to register your car, for instance. They know what year it is, and they know, like in general, what is a Ford Taurus from 2005 worth. And the appraised value is what the assessor would go out and look at your home or any equipment that's going to be taxed. And then they multiply that by 60%, and that's actually what you have to pay the property tax based on. So the formula that relates appraised value and the assessed value is right here. And let me show you these tax rates. We'll go to the assessor's website. All right, so in the city of Huntington, there's two different categories. This first one, Class 2, is applied to owner-occupied structures. And so if you have a house that the assessor thinks is worth $100,000, then you're going to have to pay $60,000. $60,000 of that is going to be taxed. And I don't know why they do it that way, but that's how they do it. So if they said the appraised value is $100,000, then your assessed value would be $60,000. And so then what you'd do is you'd multiply that $60,000, and 1.69% of that is what you'd have to pay each year as your property tax. And they divide it up into two halves. A lot of people will pay like the first half of the year and the second half of the year, just so it's not like one bill all at once. So that's Class 2. Class 4 is for properties that are non-owner occupied. And so if you own rental properties, you have to pay higher tax rates on your rental properties than people who are living in their property. I'm not sure, I mean, I understand why, because, you know, owner-occupied properties aren't for profit in the same way that a rental property is, but that's just the way they do it. And you'll notice here in rural areas that the taxes are lower. So I live in a rural area, and I pay lower taxes than people in the city of Huntington. Barbersville has even higher taxes than the city of Huntington, 1.75 roughly percent. And then Milton is the lowest of the three cities that we have in Cabell County. All right, so I have a handout for you, the in-class exercise that we're going to go through today. On the first page is looking at excise taxes. And then on the back is addressing property tax and sales tax. Just to, because we're a little bit short on time, it's already 12:35, I'm going to tell you the answer to the first question, and then you do the calculations. See, on the front page there, there's 3 questions. The first question is maybe not tedious, but it would take the time that I don't think we necessarily want to spend on it. And so if we go to that link and go through the West Virginia budget, which is online, what you'd find is that the transportation expenditures, that in 2016 the state spent $1,262,320,000 was the transportation expenditures, and none of that was spent on the road that I live on. If you drive on that road, you would definitely agree. It's like a war zone. Like, I've been to some pretty weird places in the world, and they all have better roads than I do. But 1.2 billion roughly. So what we want to do is look at, like, how are you going to recover that? If we're going to do it on the basis of registered vehicles, what would be the registration fee? The second question is, what if it was on a gas tax? How much would the gas tax need to be if we're going to try and recoup all of this $1.2 billion? Before I put the data up for the back side, let's just make sure that we understand these 2 questions on the front. So what we know is that the state, at least in 2016, spent about $1.2 billion. So if they were going to get all of that by the fee that they charge for a vehicle registration, what we find is that they'd have to charge about $1,800 per vehicle. Anybody know how much they do charge to register a vehicle? Yeah, I was going to say I thought it was around $60. Maybe if you pay for 2 years, you get a discount. I'm just not confident my car will last for 2 years, and so I always do 1 year at a time. What were you going to say?
I thought I just paid it was 103. But if you pay 2 years, don't you get cut out on the property taxes the next year?
No, you still pay your property taxes.
You just have to prove that you paid it.
Yeah, that'd be awesome, though. All right, so one way of looking at it is let's just collect it per car. It'd be a lot. Well, what about per gallon? If we wanted the entire state transportation budget to be funded by fuel taxes, then it would have to be about $1.50 per gallon. And how much are we actually collecting? What is the state fuel surcharge? It's not that much. Let's see, cigarette, excise, gas, there we go, 32 cents. Now there's also a federal gas tax, and a good portion of that federal gas tax comes back to the state, but it's nowhere near enough. And so then what that tells you is that they're probably just taking general revenue that comes to the state through other things like the coal severance tax and income tax. It's more than just these excise taxes are going to support the state transportation fund. All right, so that's the first two questions. Let me show you again the tax rates that you need for the property tax stuff on the back side of the paper. Remember, the formula is the conversion. Let me show you that. Appraised value times 6.60 is the assessed value. So assessed is 60% of appraised. Okay, so if you have a $200,000 house in a rural area, then you multiply that 200,000 by 0.6, and it turns into 140,000 is the assessed value, because the appraised is the 200,000. So the assessed value is 60% of that, and then you multiply it by 1.3746 out of 100. So you're going to have an annual tax of property tax $1649.52. And it's interesting to look at where that money's going. I told you that the assessor puts that data on their website, and they break down, they'll say, for instance, if you had a $100,000 house, then your assessed value is $60,000, and if you're living in the city of Huntington, here's where that money would go. So out of the $1,000 you pay, most of it goes to the schools, some of it goes to a general fund, but they've got it specifically broken down line item by line item to the parks, to the libraries. And it's amazing, for instance, that the libraries can survive when the average household is only contributing $12.91 a year to the library. What do we care about even less than libraries? Senior citizens. So, right? Yeah, I'm not sure what the City of Huntington TIF is. I'm not sure about that. Something improvement fund, I guess. Trail improvement fund. All right, so the last part here is if you have that same house, if you're renting it out in the City of Huntington, then your property tax is going to be double. We're going more than double. We're going from $1,650 to over $4,000 per year. And then this last one is a story about a breakfast I once had in San Diego that the prices were ridiculous to begin with. This is a real scenario. This isn't hypothetical. This is me visiting San Diego last year. I mean, what can I say? I was hungry, right? They had the monopoly on bringing food to my bedroom in the morning. So if you have the items, the Kind Bar and the yogurt, then they charge the service fee on top of that, and the in-room service charge, the guest room dining charge. You better believe I ground the crumbs into the carpet. If they're going to charge me $4 for the privilege, apparently that's a cleaning charge, I don't know what, but the taxes then is applied to all of it. So in the end, $21.26 for a Kind Bar and Greek yogurt, probably like $1's worth of food, maybe. If you went to Walmart and just bought that off the shelf, we're saying maybe $1. But that's just an illustration of sales tax to get some practice with the numbers. All right, we'll meet again on Friday. We're going to do some more review for the exam, and we're also going to be talking through income taxes, which will be on the finals. So I hope you'll make it on Friday.